Okay, so you want to own an accounting firm. And on paper, this looks like one of the safest businesses in America. Everyone needs a tax return filed. Every business needs its books kept. The demand never goes away, and the person providing it gets to charge for something almost nobody wants to do themselves. The industry backing that intuition is enormous. Accounting services generate roughly $157 billion a year in the United States, spread across more than 85,000 firms, according to industry data. Most of those firms are small. Most of them are led by a handful of partners who built the practice one client at a time. Two things to hold on to before we go anywhere. The first is a number that should sound impossible once you hear it next to another number. The average fee a CPA charges for a basic individual tax return is around $280. And in the last few years, private equity firms have been paying up to 15 times a firm's annual profit to acquire practices built on exactly that kind of work. 15 times profit for a business whose signature product sells for $280 once a year. Something does not add up unless the tax return was never the thing being purchased. The second is a crisis, the profession mostly created for itself. The number of Americans earning accounting degrees just hit a 20-year low. And the leading explanation is not that people stopped needing accountants. It is a rule the profession itself put in place, requiring extra schooling that other, better-paying finance careers do not require. We will get to both. But we start with the tax return, because the tax return is where the illusion lives. Here is the thesis, and everything else is proof. An accounting firm does not primarily make its money selling hours or selling tax returns. The visible product is often a low-margin, seasonally concentrated client acquisition tool. The real profit engine is the quiet, recurring work nobody thinks about. And increasingly, the most valuable thing a firm owns is not its talent at all. It is that recurring revenue itself. Let's start with the visible product, the one everyone recognizes. Tax preparation is, by a wide margin, the largest single service line for most small and mid-size firms. Survey data from the accounting profession's own trade association shows tax work is the primary revenue source for roughly 3/4 to over 4/5 of firms under $10 million in revenue. And the pricing on that work has moved in a specific direction. Only about 3% of firms still bill tax preparation by the hour. Almost everyone has shifted to a flat fee, which sounds like sophistication, but functionally it means tax preparation has become a commodity, priced the way a haircut is priced, not the way expertise is usually priced. That $280 average fee has to cover research, software, liability exposure, and staff time, compressed into an 11 or 12-week window between January and April. Firms describe this window bluntly. 51 or more hours a week is normal for the majority of tax season staff. Some managers and partners report 70 or more. And here is the detail that matters most. This entire surge of labor happens to produce a client relationship that, by itself, generates revenue exactly once a year. So the arithmetic of tax season, taken on its own, looks like this. Enormous effort, thin margin, a single annual transaction, and a workforce running on fumes by April 15th. Now, you could stop the video here and conclude that accounting is simply a hard, low-margin business that happens to be necessary. Many people believe exactly that, and for a firm that only does tax returns, it is not entirely wrong. But that is not where the money in this profession actually concentrates. Let's go find where it does. Set the tax client aside for a moment and look at a completely different kind of client. One who pays not once a year, but every single month. Monthly bookkeeping retainers for a typical small business run somewhere between $600 and $1,800 a month, according to current market pricing. That is $7,000 to $22,000 a year from one client, arriving automatically without anyone reselling the relationship each January. The industry's own benchmarking survey shows what this shift has done. Client advisory services, meaning ongoing bookkeeping, outsourced controller work, and monthly financial guidance, grew 17% in a single year, more than double the growth rate of the profession overall. Firms that lean into this work now generate over $150,000 in fees per advisory professional, up nearly 30% from the prior year. And notice the billing model shift here too. In this part of the business, only about 10% of firms still charge by the hour, down from over half a decade ago. Everyone has moved to a flat monthly fee, which means the firm's incentive quietly flips. Once you are paid a fixed amount every month, regardless of hours, getting faster and more efficient does not cost you revenue. It expands your margin. A bookkeeping engagement that took 12 hours a month can be automated down to 8, and the fee does not change. The effective profitability of that exact same client just went up by half. Nobody experiences this as dramatic. The client just gets a bill on the first of the month. But structurally, that quiet, boring, automatic bill is doing something the exciting tax season workload never does. It is compounding. If you know somebody who thinks their accountant makes most of their money doing their taxes, this is the part to send them. For a firm running both kinds of work side by side, the tax client and the bookkeeping client are not the same business. One is a doorway, the other is the house. Now here is the second thing I promised you, and it explains why outside investors suddenly care about a profession most of them never thought about before. Since 2021, private equity has been buying accounting firms at a pace nobody in the profession predicted. Industry trackers counted 47 private equity-backed deals in 2023, 76 the following year, and over 180 in 2025. More than a third of the largest 30 firms in the country have now taken outside capital. Here is the structural trick that makes this legal. Most states require that a firm doing official audits stay majority-owned and controlled by licensed accountants. So these deals split the firm in two. One entity keeps the audit work and stays accountant-owned, exactly as the rules require. A separate entity holds the tax, bookkeeping, and advisory work, and that second entity is free to take outside investment. Private equity is not buying the audit. It is buying the recurring side. And the price they are willing to pay tells you everything about how differently they see this business compared to the partners who built it. A firm dominated by seasonal compliance work sells for something like 4 to 6 times its annual profit. A firm where most of that profit comes from recurring monthly advisory relationships can sell for 7 to 11 times, and in the most extreme documented case, one of the largest deals in the profession's history was valued at roughly 15 times profit, specifically because it was 15 times for the same industry that charges $280 for a tax return. The gap between those two numbers is not a coincidence. It is the entire thesis of this video, expressed as a price. Now, I want to be fair here, because this is a genuinely contested development inside the profession, and both sides have real arguments. The case for private equity is straightforward. It solves succession. A generation of partners is retiring, and historically the only exit was selling to younger partners at a fraction of what the practice is actually worth. Outside capital lets a founder capture real value, funds better technology, and according to advisors who track these deals, most of the acquired firms have hit or exceeded their financial targets. The case against it is just as real. A survey of accounting staff found that roughly 2/3 believe private equity ownership will hurt independence and client service, and just over half expect clients themselves to suffer. One prominent episode involved a major firm taking over $1 billion in debt from a private equity sponsor that was reportedly betting against one of that very firm's own audit clients elsewhere, which is about as direct a conflict of interest as this profession can produce. The firm involved threatened legal action against the trade press that reported it. Both of these things are true at once. Private equity is solving a real succession problem, and it is introducing a real conflict of interest risk into a profession whose entire value proposition is independence. The debate inside the industry is not settled, and I am not going to pretend it is. Now, back to the second thing I promised you, the one about who fills these jobs at all. The number of Americans earning accounting degrees fell to just over 55,000 in the most recent academic year, the lowest level in 2 decades. New CPA exam candidates dropped by more than 1/3 in a single recent year. The share of firm staff who are actually licensed CPAs fell from 56% 5 years ago to under 49% today. The most commonly cited explanation is not that accounting became less necessary. It is a requirement almost every state adopted decades ago, mandating an extra 30 college credit hours beyond a standard bachelor's degree before someone can even sit for the CPA exam. That is roughly a 5th year of school, an extra year of tuition and lost income to enter a profession whose starting salaries have historically lagged other finance careers that do not require it. The profession's own national association has now moved to soften this, approving an alternative path that allows a standard bachelor's degree plus 2 years of work experience instead of the extra schooling. More than a dozen states have already passed versions of this change. I want to be even-handed about this one too. The extra schooling was designed to protect the quality and credibility of financial audits that the public depends on, and that is a legitimate goal. The counter-argument is that it turned into an expensive toll gate that shrank the pipeline into the profession for 2 decades at exactly the moment the profession's demographics were already working against it. Reasonable people inside accounting disagree about which effect was larger. What is not in dispute is what firms have done in response. Offshore bookkeeping labor in India and the Philippines now costs roughly $10 to $25 an hour, against $40 to $75 domestically. Major firms have expanded operations overseas specifically to staff this exact kind of recurring, rules-based work. And artificial intelligence is now automating the same category of task. Adoption of generative AI tools at tax and accounting firms roughly tripled in a single year. Put those two forces together and you get a clear pattern. The seasonal, rules-based, compliance-heavy work, the tax return itself, is exactly the kind of work that offshoring and automation compress fastest. The advisory relationship, the ongoing judgment call about a client's business, is much harder to offshore or automate. Which means the exact work this video already identified as the low-margin front door is also the work most exposed to getting cheaper and thinner over time, while the recurring advisory relationship becomes, if anything, more valuable by comparison. So let's put a year on it, both ways. In the good scenario, you run a firm where advisory and bookkeeping retainers make up most of your revenue. Your tax season exists, but it functions as it should, a chance to deepen a relationship you already have rather than the entire year's survival plan. Your billing is automatic. Your margins expand as your systems improve because nobody is paying you by the hour. If you eventually want to sell, buyers value your firm as a recurring revenue business, not a one-person show, and the number reflects that. In the realistic scenario, your firm looks almost identical from the outside, but the mix is inverted. Most of your revenue arrives in a single quarter. Your staff works punishing hours from January to April, and then sits underutilized for the rest of the year. Your fees are set by the market rate for a commodity, because tax preparation is a commodity now, whether or not you like that word. You are profitable, but your profitability depends entirely on surviving 11 weeks in reasonably good health every single year, indefinitely. Nothing has gone wrong. Your clients are happy. Your reputation is excellent. You just built a business whose entire economic engine runs through a single narrow window, and every structural trend in the profession, offshoring, automation, and the buyers now shopping for firms, is quietly rewarding the version of this business that doesn't. That is the whole thing in one line. In almost every other business, the product people see is the product that makes the money. Here, the product people see exists mostly to open the door to a second, quieter relationship. And it is that second relationship, paid automatically every month without anyone reconsidering it, that the entire profession, and now an entire class of outside investors, has quietly decided is the real business. Which means the honest question was never whether people will keep needing their taxes done. They always will. The question is whether the firm doing it built something that only exists for 11 weeks a year, or something that keeps getting paid in the other 41. This video is general education about how an industry works, not business, financial, tax, or investment advice. If you want the underlying numbers, the American Institute of Certified Public Accountants publishes detailed benchmarking data on firm revenue and margins, and private equity activity in the profession is tracked and reported regularly by industry trade publications.